Hi everyone. Today we're going to talk about Rambus's first quarter of 2026, a quarter where the chip business kept pulling ahead while the royalty engine kept slipping. Let's see what's in the numbers, what's surprising, and what to watch. Quick context. This is a memory infrastructure company sitting at the heart of the AI build-out. Stick around, there's a contrarian number coming up right away. Here's the contrarian number for the quarter. Product revenue, that's the chip business, was up 15% year over year. Royalty revenue, the legacy patent licensing engine that built Rambus, was down 6%. And operating income? Flat. $75.6 million this quarter versus $76.3 a year ago. So the company is selling more chips, charging less in licenses, and ending up roughly where it started on profit. That's the puzzle of this quarter. Quick context on what Rambus actually does and why it matters right now. Rambus is a 35-year-old semiconductor company that sits between the processor and memory. They sell two things: chips that physically connect memory to servers and silicon intellectual property that other chip makers license. Their customer list reads like a who's who of silicon: NVIDIA, AMD, Samsung, SK Hynix, Broadcom, Qualcomm. About 800 employees, 2,000 patents on the books. The thing to remember, they don't make CPUs or GPUs. They make sure those chips can talk to memory fast enough to keep up with AI workloads. 3 revenue streams. Chips are about half of what Rambus sells now. That's memory interface silicon for server modules. Roughly 40% is royalty, licensing the patent portfolio to companies like NVIDIA and Samsung who use the IP in their own chips. The remaining 12% is contract revenue, mostly silicon IP cores like high-speed interfaces and security blocks. The mix has been shifting. 5 years ago, royalty dominated, now chips do. On to the headline numbers. 4 numbers. Total revenue, $180 million, up 8% year over year. Product revenue, $88 million, up 15%. Cash from operations, $83 million, strong cash generation again. And the cash pile itself, $786 million, up 53% in 12 months. To put that in perspective, Rambus is generating cash faster than it's spending it, debt-free with a year's worth of operating expenses sitting on the balance sheet.
$180.2 million in revenue, up 8% versus the same quarter last year. But, and this is the part the headlines miss, down 5% sequentially from Q4 2025. Q4 had a royalty true-up that didn't repeat. So, year-over-year strong, sequentially soft. Both stories are true at the same time.
Now, let's pull the revenue apart, segment by segment. 5 quarters of revenue stacked. The pattern is clear. The cyan band, that's the chip business, has been climbing. The gray band, royalty, has been roughly flat to down. And the orange sliver at the top, contract revenue, is the smallest piece but the fastest grower. Q4 last year was the peak so far, helped by a royalty true-up. Q1 stepped back from that high but kept the year-over-year growth in chips intact. A year ago, product revenue, the chip line, was $76 million. Pretty clean baseline. Worth remembering this number because we're going to walk it forward 4 quarters. Through 2025, chip revenue grew quarter over quarter, 81, 93, 97, 3 straight quarters of sequential growth peaking in Q4. That's the DDR5 ramp in real time, server memory chips going into AI training racks.
Q1 came in at $88 million. That's 15% higher than the same quarter a year ago, but 9% lower than Q4. The sequential dip is normal seasonality plus customer build patterns. The year-over-year is the line that matters. Rambus is selling more DDR5 interface chips than it ever has.
$88 million in chip sales, 15% more than a year ago. To put it bluntly, this is no longer an IP licensing company that happens to make some chips. This is a chip company that happens to license some IP. That's a different stock to own. Side by side, product up 15%, royalty down 6%, contract and other up 38% off a smaller base. 2 engines accelerating, 1 decelerating. The question for the next 4 quarters is whether contract revenue can keep that 38% pace because royalty is structurally weaker. Here's the royalty line over 5 quarters. Started at 74, ended at 70. Q3 was the trough at 65. That's the quarter that scared people. Q4 bounced back on a renewal. Q1 settled at 70, down 6% year over year. Management says it's timing, license cycles, not lost customers. But watch this line for the next 2 quarters.
Why is royalty volatile? License agreements run up to 10 years, so any given quarter sees a different mix of fixed fee, variable, and renewal payments. Q3 last year was a low point at $65 million. Q4 bounced back to 72 on a renewal. Q1 settled at 70. Licensing billings, the cash measure that strips out timing, were also down a couple of million YOY. So the slow drag is real, but it's not a single client walking out the door. It's slope, not cliff. Where the customers are, geographically. South Korea, 86 million, 48% of revenue. Singapore, 28. United States, 22. The rest split across Taiwan, Japan, China, and others. 88% of revenue comes from companies headquartered outside the U.S. That's the memory industry. The world's DRAM is made in Korea, Taiwan, and China.
48%. That's how much of Rambus's revenue this quarter came from companies in South Korea, home of Samsung and SK Hynix, 2 of the 3 biggest memory makers in the world. A year ago, that number was 41%. The concentration is climbing. Good news, it tracks where the AI memory dollars actually live. Risk, a single regulatory or trade event in Seoul moves the whole top line.
Top customer in Q1 was 29% of revenue, up from 23% the year before. Top 5 customers were 70%, basically unchanged year over year. Korea, as we said, 48%. The good signal, $30.9 million in remaining performance obligations on the balance sheet. That's signed but unbilled IP backlog over the next 2 years, locked-in revenue. Now to the cost side. How $180 million in revenue becomes $60 million in net income. Cost of revenue takes 36.5. R&D takes 50.2. That's the biggest single line, and that's where most of the cost growth is. SG&A takes 32. Operating income lands at 62. Interest income adds 7. Tax takes 9. Net income 59.9. Same as last year on the bottom line, even though revenue grew 8%. That's the margin compression in one chart. Lined up side by side, here's how each cost bucket grew year over year. R&D leads at 18%, the biggest single source of margin pressure. Cost of revenue grew 11% on chip volume. SG&A grew 13%, mostly legal expenses and payroll. Revenue grew 8%. Costs grew 11 to 18. That's why operating income is flat. 18%. R&D up that much in a single year. $50 million a quarter going into engineering, 28% of revenue. That's not a maintenance budget, that's an offensive budget. The bet, AI memory is moving fast enough that whoever's first with the next-gen interface wins the design slots that ship through 2030. 4 product lines: LPDDR5X, SOCAM2, a new server memory module designed for AI rack density, HPM4E controller IP for the next generation of high-bandwidth memory in GPU accelerators, an Ultra Ethernet security engine for data center networks, and continued extension of the DDR5 chip family. All 4 target the AI data center. That's where the R&D budget is going, and that's why the cost line is running. Cash and marketable securities, $514 million a year ago. 786 today, up $272 million in 12 months. 0 long-term debt on the balance sheet. $83 million more in operating cash this quarter. Whatever's happening on the income statement, the cash machine is working.
$786 million cash and marketable securities. 0 long-term debt. Equity of $1.4 billion. A company that could write a check tomorrow for almost anything in its size class. The only question is what they'll do with it. What management has signaled for the rest of the year.
Q2 guidance, midpoint of the ranges. Product revenue, $98 million, 11% more than Q1. Royalty, $75 million, bouncing back from the Q1 softness. Contract, $22 million, holding. Total guide implies about $195 million for Q2, which would be the company's biggest quarter ever. Beat or miss against this number is the next read.
What management announced on the product side? LPDDR5X SoC DIMM2 is a new server memory module. Rambus is one of the first to ship the chipset. HBM4E controller IP positions them for the next wave of AI accelerators after the current HBM3E generation. An Ultra Ethernet security engine targets the data center network layer. Each is a multi-quarter design cycle landing in 2026 and 2027 product.
4 things to watch. DDR5 chip ramp. It's the engine of the 15% product growth. Royalty renewals. That's the sliding line, and a new license could shift sentiment. OpEx growth. Non-GAAP costs went from $90 million a quarter to $105 in a year. If that pace continues, operating income compression continues. And design wins on HBM4E and SOCAM2. Those are the futures contracts.
The bull thesis in one line. Every AI accelerator, every Hopper, every Blackwell, every TPU, every Trainium needs more memory bandwidth than the generation before. The memory wall is the bottleneck. Rambus sells the chips and IP that punch through that wall. As long as the AI build-out runs, this company has a runway. Now the verdict, both sides.
Bull side, product revenue up 15% on AI memory demand, $786 million in cash with zero debt, and a roadmap stacked with HBM4E, SOCAM2, and Ultra Ethernet, design slots through 2027. Bear side, royalty revenue sliding 6% year over year, secular, not cyclical in some analysts read. Operating income is flat despite revenue up 8%. Top 5 customers are 70% of the business, and South Korea alone is 48%. Concentration is rising. Both columns are real. The question is, which trend is faster?
What we don't know, can the chip line keep up the 15% pace while royalty drags 6%? Will the R&D investment turn into design wins that show up on the income statement in 2026 or just into a permanently higher cost base? And will the company finally deploy that $786 million cash pile, buybacks, dividends, and acquisition, or keep stockpiling? Q2 guidance answers the first question. The other 2 get answered over the next 4 quarters. So that's Rambus, first quarter 2026. Same profit on more revenue, more cash on the balance sheet than ever before. A chip business overtaking a royalty business, and a billion-dollar R&D bet on AI memory infrastructure that pays off or doesn't over the next 4 quarters. That's it for today. Don't forget to subscribe.